Welcome to TradeDMBI.com. This is John's report is for the 13th of December, and the continued, Christmas rally, if you want to call it that, even though it started back in November, continues without any major news to derail things. Still just what you would consider that positive year-end run, and we're getting close to the August highs again. And interesting that, as you would see, that we're moving towards the highs. CPI numbers came in higher than expected, which wasn't unexpected for us because we expected them to come in at that number, and or at least relative to it, which is higher than the Fed's general view. But it also throws a huge damper on the market view that rate cuts are imminent. Clearly they're not, and so is there a delusion there? Well, of course, there's always a delusion to some degree, but the idea that it's going to be a rate cut going into the future, not so obvious. And I think it's always been a situation where we've talked about this for quite some time, that the Fed, once they started raising rates, the idea would be to raise them, always be slightly behind the inflation curve, always behind on their projections, because again, that devaluation overall helps, doesn't solve anything as long as the deficits continue to be exponentially larger than the inflation rate that's running. But then again, we all know that the inflation that's running is higher than what is officially listed anyway. So it serves a secondary purpose, and no one's really going to talk about that. The bond market way out of whack to where real rates are and where they're likely to be for the next coming months, because unlikely we're going to see some change in that. But it also indicates that there's a bigger move towards treasuries, which means that there's probably a little bit lighter flow. However, you have to split that, because now that the yield being so much lower, it really throws off whether you need to be in the market. And so obviously a lot of money's had to move into the market to make up for that discrepancy. So you have that. You also have the bonus of oil continuing to slide, and now we've completed positive extremes all the way through, going back to the beginning of the original run, which was back here in late July. And with that having been filled, you've got a complete return. So that only bolsters potential growth, or at least the stopping of activity completely, even though things may have slowed down. We're going to get into that point now coming into the beginning of the year, where the rate increases will start to have a material effect that the Fed will notice, and that will give the Fed a clearer idea of things. But of course, the market believes that they're going to see that things have slowed significantly, and they think that the Fed's going to change course. And I think that that's confusion, because it's exactly the opposite of what they've been describing they're going to do. So again, it's one of those where they think they can, outwit the Fed or force the Fed into something that isn't necessarily going to do it. Plus, there's probably a strong belief that in an election year, they're going to want to support the administration by, keeping things softer and helping things. But even if they change something at the start of the year, it'd be too late. It wouldn't have a material effect. You might begin to start to see the effects of it towards the election time, but they would have had to have done it now in order for it to have had any substantial impact. So that's not going to be a bonus for current administration going into the election. From a euro standpoint, again, relatively high relative to where the eurozone is, and this is also a reflection of both the weakening of the dollar, but relative to the euro, the dollar is still fantastic, and this is still extremely elevated relative to that growth. So, it's nothing new. There's always been the prop up of the Eurozone, because if that starts to implode with the bifurcation that's been created with the war in that, you've got added problems. So they really need to try and do their best, at least from a Fed level, to support the euro. So that's just something we expect. And from a gold standpoint, it's filled all its positive extremes and just showing a little weakness. And it's interesting because when you see those CPI numbers and everything else, arbitrarily low relative. And again, we've talked about how that's easy to do. This is why you've seen a little bit more of a move from your cryptocurrencies, because they're not necessarily as tied to the kind of impact that you have when you have paper markets and futures that can drive things down, which was the point of having the Bitcoin futures and that to be able to do that to a degree, but doesn't have the same impact. And so while we've seen a pullback, it's nowhere near having filled any of their positive extremes going back. And we know that that can extend for quite some period of time. So it's just a matter of following our readings as we go. The fact that they've held pretty decent support at the 76, still have potential of doing so, but if we see the white MBI move over magenta, that becomes more difficult. We already have the DOC spread, but the fact is we were having steel coming from below, so that should be enough to give it the support needed to keep it from breaking that 76% support range. ETH, Ethereum, a little bit weaker overall, but it's going to be relatively supported along with Bitcoin and some of the others. And from our 50K standpoint, you can see we've had still plenty of, while it may look like the print is always positive, there's still plenty of little dips that take place that then lead to the new rally. So this, I think, is very healthy in the sense that you get the pullbacks, fill in positive extremes, and then you have another run. And then you have another set of positive extremes that are created. It's slightly higher than the previous one, and you keep rinsing and repeating. And that's exactly what's happening. So you can see this from an intraday. So in the pre-market, drive down, clear any stops, and then right by the time we get to the cash open there, you're ready to go and propel from there. So then we see in the post-market, as we are right now, we're still positive, so didn't even really see much of a fade back at all. And relative to the went too far there, the benign situation that's currently where things are at, it's all rosy, it's all Christmas, Santa Claus happy. But as we know, that can change very quickly, so we have to stay on top of intraday readings and that as they move. But for now, we're just going to continue saying ho, 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 and go with it, and just follow the readings as they come. As always, anything relevant, I will certainly put up on the Skype chat. Have a good one. Trade well.